Welcome to Market Demystifiers. In this channel, we will analyze and break down the market, focusing on the US market, so that each of us can have a good understanding of what is happening around us and what we can expect will happen in the near future. The media feeds us with a certain perspectives. Some large players want us to have a specific way of thinking. So what we would be doing here is basically analyzing the facts, the data, the underlying statistics to have a good understanding of what is really happening in the market. The goal of today is to understand where are we in the current economic cycle. Is expansion ahead of us or rather a recession? What about the labor market? Is the consumer strong? What about the last decade? And can this situation be repeated? And last but not least, we also want to talk about the Fed and the current monetary policy. And this is part 1. Alright, so let's start with a quick video from President Biden, who is expressing his opinion about the recession.
Let me put it this way. I've been hearing every month it's going to be a recession next month. The consensus is 2/3 of the economists and the major leaders in the banks think we're not going to have a recession. I don't think we will either.
Let's now assess the statement by looking at some leading indicators. In front of you, you have the yield of the US Treasury notes. The Treasury is basically a government debt security which you can buy to get interest. On this graph, you can see the yield of a 10-year Treasury minus the 2-year Treasury. The yield is the return that the investor can expect. Whenever it is below zero, as you can see here, it happened on multiple occasions. Since 1971, it always resulted in a recession, and the recessions here are in red. When the yield curve is inverted, that means that the demand in the bond market is higher for the longer durated treasuries from the short dated treasuries. And why it is the case? So in simple terms, the bond market, which is called the smart money, is predicting a recession, a contraction in output, and they prefer the long-term treasuries from the shorter term. So the crucial thing to remember from this graph is that the yield curve inversion has predicted each recession since 1971. It has a 100% win rate. And the current inversion is the steepest from 1980. Now let's look at another graph. So here we have the spread between the 10-year Treasury yield and the 3-month Treasury yield. And this is a model which was created by the New York Fed, in which they also assign probabilities to a recession. And as you can see, we also have quite high 70% probability. And if you look at this model since 1961, the 70% probability is one of the highest probabilities which the model has shown. So we had the classical bond market, we also had a use of it by the Fed, and now we have also a model created by the Conference Board, which is using the US leading economic indicators to also foresee turning points in the markets, and it's also flashing a recession signal. In summary, the bond market, the leading economic indicators are predicting a recession. And one important thing to remember is that the stock market and the S&P 500 has never bottomed before a recession. Of course, some will say it will be different this time. Would it be? Let's see. Let's now move to the labor market. We often hear in the TV or the news that the labor market is so strong in the US that there is no chance of a recession. And it's repeated across many important and vital persons. The Treasury Secretary also said that you don't have a recession when you have such a strong employment. So let's see if it is the case. Please have a look at this chart. If you see here, the red lines are the recessions. In the black color, you can see the US unemployment rate. And you can easily see that the unemployment rate is extremely low just before the recession hits. And it spikes significantly. Another factor which can cause the labor market being so strong is that because of COVID, the US citizens had created large amount of savings. But as you can see on this chart, they are using this excess savings. As long as the consumers have those savings, they can feel safe. But as you can see, they are very quickly evaporating. Okay, so the savings are almost gone, and look here, the debt is skyrocketing. is going higher and higher, and let's not forget that the interest rates will be higher for longer, so it would be very difficult to refinance the current level of debt. Unfortunately, the constantly rising interest rates will only aggravate this issue and cause even more pain to the consumers. The future is not bright. Based on a paper from New York Fed, the effects of this tightening cycle might be the strongest since 1970. And based on their paper, the effects will peak around 1 to 2 years after the shock, which means that we are yet to feel them in full effect. One can ask, why are we in this situation right now? And the answer is, in the last decade, all of the central banks have printed really a lot of money. They have inflated the markets with cash, and the interest rates were abnormally low. From the global financial crisis, the central banks realized that whenever there is a problem, they can just give us cash, and this will solve the problem. And yes, in the short term, it will fix the problem. Look how addicted the stock market became from the liquidity provided by the Fed and other central banks. Look at the enormous increase in the Fed balance sheet when COVID happened, when basically Fed was saving the system. And it was all right until it wasn't. As if you flood the system with money, the value of money will go down and inflation will come. You can pause this slide right now and look how amazing is the correlation between the Fed liquidity and the stock market. And in the last decade, apart from the massive injections of liquidity, the interest rates were also very low, like close to zero. So this was a beautiful environment for growth. Unfortunately, some executives in companies wanted to take a further advantage of the situation, and instead of investing in research, development, production, they were buying back stock on an enormous scale. Now, if a public company buybacks its stock, it basically makes its stock more scarce, so it inflates its value. As you can see here in this review, those buybacks have no contribution to the productive capabilities, and in the past decade they amounted of 52% of net income. Over the decade, it was 4.3 trillion of dollars of buybacks. If those buybacks doesn't help the company, why does the firms do them? Well, it's because the bonuses of the executive team, the CEO, CFO, COOs is dependent on the stock market. Because in the end, investors look at the price of your stock. So they will do it. But this age, the decade of easy money, of very low interest rates, of massive quantitative easing, so pumping the market with liquidity, it's gone. Maybe the current valuations of the companies might need some reflection upon the new norm. Moving to the Fed and the monetary policy of the US, they have raised rates very quickly. The rate of change was very high, was significant. Why they will not cut them? It's because they really don't want the situation from the 70s and 80s to repeat. And as you can see, the inflation was going up and down, up and down, up and down, and such a situation is really bad for a sustainable growth. Even though you hear in the media that inflation is gone, that in the headline inflation in US is 4% from 9%, such a big decrease, if you look closely, the headline inflation is the blue line. The core inflation, which excludes the volatile food and energy prices, is the red line. And there is really little disinflation in the core inflation, which basically is the one which Fed tightening policy should affect the most. And I think that the Fed is really surprised by it. They don't really know until when the full effects of the rate hikes will kick in, but for sure they were hoping for it to see the disinflation in the core sector earlier. Let's now analyze the last inflation report from the US. So the year-over-year headline inflation is 4%. And if you look at this table, you will clearly see that the vast majority of this change is caused by the decreases, by the deflation in the energy sector, where the year-over-year change is negative. As a result, even though the headline inflation went down from 9 to 4%, it was clearly done because of the decrease in the energy prices. But everything else on which the Fed should be able to make an impact on is still extremely hot. There is very little disinflation. This is a very warning signal, not only for the Fed but also for the US consumer, because the inflation in the sectors which impacts you the most is still going on. So the demand was already distracted, your real income has been already decreased significantly, and right now there is really little sign that it will stop soon. Because of those reasons, the Fed simply cannot stop yet. They paused on the last meeting because they are afraid that they will break something. And we will talk about it in the second part, in the second video. But as you can see here, they have increased the Fed fund rates significantly. And historically, when the rates were that high, usually something breaks, and usually we go into recession. It's not like it's only me who see that the Fed needs to go higher. Even though they paused at their last meeting, as you can see here, they increased their terminal rate projection for this year by 50 basis points. So the Fed is also in consensus to rate to have a higher interest rate and to keep it for longer. And it also aligns with what Jerome Powell, the federal chairman, is saying on the interviews, as I believe they know that they should not have paused. They did it, and now they are trying to tell the world that sorry, we are still going forward. It is just a slight slowdown, but we will be back on track soon. And that's all what I wanted to cover today. So, see you in the next video. Please comment, like, and subscribe if you enjoy the show. See you.